Hey, good afternoon. You're watching the newsroom right here on ET Now. I'm Ajay Sharma. The markets are actually at day's low. Look at the Nifty intraday and the Bank Nifty intraday, and you would see that it has nosedived towards the lower end of the range. In fact, it's a very important technical level on the Nifty. 17,454 or thereabout was the anywhere between 400 and 500. We were taking support and rebounding. If we are going below that, one needs to take a closer look and be slightly more careful if you're a trader. But if you're an investor, how should you be looking at this corrective phase? Nishit Master of Axis PMS is here with us. Nishit, afternoon. Thank you so much for your time. How are you analyzing the worries on the mind on the market right now? Which are the worries to your mind?
So essentially, the market is worried about two things. One is that inflation, which was coming down earlier, now appears to be a little more stickier than what it, was earlier thought of. So rates globally are expected to be on a higher side and for a longer period of time. So that's where the entire asset class or asset classes would need to be repriced. We are looking at slightly lower multiples for the market going ahead because essentially cost of capital is going up. So this is where the key concern for the market is in the short to medium term. Another factor which was impacting the market earlier was essentially Indian valuations being higher than global emerging market valuations. And here, especially when China was opening up, you saw some amount of FPI money flowing to China, preferring China over India, essentially playing up the opening up trade, as well as lower valuations in Chinese markets.
How are you analyzing the valuations then in this light? The current valuation after the Q3 numbers were done, you may have worked your math as well. Are the valuation looking slightly on the high side even from current levels?
Yeah, so from even current levels, so our Nifty estimates in terms of earnings for FY24 is around 935, and for FY25 it's 1060 or 10, slightly less than 1060. Now, if you factor that into numbers, then you're looking at the markets currently being at around 19 times FY24 earnings and 17 times FY25 earnings, which appear slightly on the higher side. Historical average, is close to 16 to 17 times for our markets. So yeah, so markets appear expensive, say by around 5 to 10%. But part of this expensiveness could be justified by the higher earnings growth and higher economic growth which India is expected to witness versus other major economies.
Point. India has managed to command a premium because of its superior quality, earnings, and growth. But there are periods of the market when other markets start looking better, appearing better, and there's a trade, and that perhaps actually played out. Let's talk about the quality of earnings from here on, also because in light of there is some amount of growth slowdown which is actually hitting. We saw some of it getting reflected in the past quarter. Would you be requiring, or the market would be requiring, to scale back the earning estimates meaningfully for the next 1 year forward? Because perhaps the earlier estimate did not capture the growth slowdown.
So, if we talk about our earnings estimate, our earnings estimates have not changed significantly from what they were, say, 3 months back. Our Nifty EPS estimates for FY23 have been lowered by less than 1%, while our estimates for FY24 and 25 have slightly gone up. There has been, for sure, a sectorial shift in terms of which sectors were earlier expected to, show far better earnings, and which sectors are now expected to show far better earnings. A, a clear distinction in terms of, commodity producers in terms of metals and oil and gas. This is where we've seen earnings estimate being cut significantly. While on the other hand, we've seen earnings upgrade in banking, in auto. And in terms of, if you ask me personally, the quality of earnings in banking and auto, which is a lot less cyclical than metals and oil and gas, in terms of quality of earnings, we've seen improvement in quality of earnings estimate going out.
That's interesting. Talk to us about the complexion of your portfolio. What kind of themes are you most overweight on? Or let me put it this way, since we cannot talk stocks, stocks which are largest positions in your portfolio, what kind of areas do they belong to, and why, and what kind of fundamental factors are play there?
Okay. So as I said, right, we've seen significant improvement in earnings for auto and banks. So these two are spaces where we are so we have significant weight in. Apart from that, we have significant weight in industrials as well, where we've seen, order inflows being pretty strong and continue to remain strong, while they are also benefiting from the fall in metal prices globally. So you're seeing margin expansion along with revenue growth momentum being there. Um, Another area where we are seeing some turnaround is cement, where after close to a decade low margins witnessed in Q2, this quarter we saw a sequential improvement in margins, and we expect margins to keep moving, uh, up for the cement sector in the next few quarters. One on the lower base, two on lower energy prices, and three because of a strong volume momentum growth which they are seeing. So you could expect double-digit volume growth for cement players, and that will lead to higher pricing for their product.
Okay, one last word. Mid cap and small cap basket, end of the universe of the stocks. How are you looking at the quality of valuations versus earnings equation actually it is trading at? Because they started correcting way before the large caps. Are they likely to bottom also before the large caps? Have value arrived there? Or if the market goes down another 5-7%, will value start arriving there? How would you approach that end?
So historically, we've seen that small and mid caps correct a lot more than large cap. We've seen that of late. We believe that once the market bottom, makes a bottom somewhere, you will historically we've seen that the large caps move up faster initially, and then the catch up happens with small and mid cap, and then that catch up picks up steam to a great extent. We believe, historical precedents should hold. Uh, Currently, small and mid cap. So you are seeing some islands where we are seeing valuation comfort, but still, there are a lot of spaces in small and mid cap space, even after the correction, where the valuations are still, higher than historical multiples.
We'll let you go on that one. Thanks so much for joining us for this conversation this afternoon.